All right, folks, welcome back. This is going to be a price action lesson for the trade I did on July 6th, 2021. But before I do, this is just a reminder. Tomorrow is the 9th, so your payments will have to be made by tomorrow. Otherwise, on Saturday, we will be removing those individuals that haven't made their payments. As a side note, if you do lose your access, most of my staff are taking a vacation in the coming week, so we will not be processing any payments before they come back. In other words, the 18th, that's when they'll start resuming any payments that were made late. So just make sure you make your payments on time and you'll have no problems. All right, so here's the British pound. This is our hourly chart. Now, obviously, this is in concert with everything I've already showed in the live recording and the commentary I gave you over that whole entire day range. The hourly chart here is what I'm going to be framing all the logic used in that trade. So here's the 6th of July, 2021. So that is the entire daily range from midnight to the 7th of July's midnight. Draw your attention to these relative equal highs here. Now, think of this as an original consolidation. The market leaves the consolidation, comes back into the consolidation, distribution, another level of distribution, smart money reversal, low risk buy, reaccumulation, and clearing the original consolidation. So we have a market maker buy model. Once it trades above the buy side liquidity pool, resting above these relative equal highs, we have purged the liquidity within a market that is bearish. So what else is going on over here? Well, if you take a closer look, the shaded area here again is the focus, but look over here in the left side of the chart. You see that? We have a high, low, higher high. These two consecutive down close candles is our bearish breaker. So that entire range is where it could trade up into, above the buy side liquidity pool, completing the market maker buy model into a optimal trade entry, high, low, retracement in. So we're at a premium and we cleared liquidity and we're at a premium PD array. The market breaks down, takes out this short-term low, then trades back up in. That return back up into the breaker right there, that is the ideal entry. Dropping down into the 15-minute time frame, all things being as they were on the hourly chart, just reducing it to this time frame. I want you to take a look at that area right there. This is a mitigation block. The difference between a mitigation block and a breaker is that if there is a lower candle close here prior to this being a breaker, okay, this is an actual breaker, but we have a candle lower than that than here. So this is a mitigation block. Now, if this high would have been higher than this one, and the lowest down close candle, that also would be a mitigation block. So it's a matter of how you use present narrative and price action to classify mitigation, because both a breaker and mitigation block are essentially mitigation. So the mitigation block is traded back up into, and inside of that mitigation block, you have our fair value gap right there. So the market trades up into that, midpoint of that as well. The bodies of the candles respecting the fair value gap within the mitigation block. Look closer. You have a short-term high, short-term low, short-term high, optimal trade entry. You can see that here. The 79% retracement level and the 62% retracement level. We don't need the 70.5 level, but you can see it clearly goes and turns at that point. So you have optimal trade entry after our market has traded to buy sell liquidity, completing a market maker buy model on the hourly chart within a bearish market on the daily. We are expecting higher prices in that volume imbalance on the daily chart for dollar index. So all of that working towards this short-term premium relative to this high and this low. We don't need an overbought indicator to tell us this is overbought, and we are pinpoint entry inside this fair value gap. So dropping down into a 5-minute chart, same reference points, high, low, high. You can see we traded back up into this fair value gap there. Look at the bodies, again, respecting that level, even on this time frame. Displacement to the downside. Now, initially, we were looking for this low and then this low. And it was for bread and butter setups. Now, I'm going to amplify this teaching to include what the daily day trading projections would be using all of the same things that was outlined on the trade that was shared with you on the 6th of July. So obviously we're inside the New York kill zone, 7 a.m. to 10 a.m. New York time. And at 7 a.m., for a session trader's perspective, that means kill zone specific. Now, if you don't want to trade London and you're primarily focused on New York, and I honestly believe all of you should try to master this session because it has the most advantages, it's easy, and it has big news usually between 8:30 and 10 o'clock. Typically every single day. Now this day at 10 a.m. we had ISM numbers for dollar. So at 7 a.m. we see the market rallying up. We understand this as a Judas swing. This is market protraction where it's taking the market against the expected direction that it's going to deliver at a later time. So all of this is your classic ICT Judas swing. And now I want you to focus on this high and this low. This low is a fulcrum point. What does that mean? Well, if we break straight down and below this low to that high is your primary swing. So this is one standard deviation. So once it breaks, you can start looking for a half a standard deviation, one standard deviation, 1.5 standard deviations, or you can run your fib from this high down to this low like this. We have a high to low, and I'll show you the settings here so you can see everything that's being shared with you. But this was first partial, second, and this is me teaching you running down equity. So every time it creates a new lower low, learn to take profits there. Take something off. And then once it trades below this level here, this whole candle is where the limit order was tagged. And I always like to get out above the level I'm trying to reach for. And that was a nice bread and butter setup. Now for day trading purposes, not bread and butter scalps, you want the daily range. Same premise here. If you didn't go in at London, New York, just as well. This level down here, 1.5, pretty much nails the low of the day. But let's look at a little bit more detail. High to low. Now again, why am I using these two price points? This is the low prior to the run up into New York kill zone. We're primarily focused on 7 a.m. So that run up sets the stage for a break in market structure. This is not a break in market structure there. This is a break in market structure because we have a potential turning point here. Then the short-term low prior to that run up, that is the break in structure. See, everybody wants to look for a higher high, and then it breaks it, okay, and calls that a market structure break. It's not. You have to have the narrative in the marketplace to align yourself with a shift or break in market structure. That's what we see here. And once it breaks down, everything else I outlined in the video is sufficient enough. If you look at the Fibonacci settings here, you can see what's being toggled, what's being shared and shown in this video. in the respective levels here, okay? And ultimately, there's your projected low. And all I'm doing is using swing trading concepts that I teach you in the core content. So this whole premise here of using the high to the low, and once it breaks this low, how far can it go down? That is standard ICT swing trading. It's this classic, simple stuff that leads to really good, ideal scenarios for targets. Now, obviously, I told you on the 6th that it could trade down 40 pips below that 138 big figure, which would send it to around 137.60, and we saw that it did that. And from a Power 3 standpoint, if you treat New York session like the daily range or true day, where it begins at midnight, ends at later in the afternoon New York time, the same thing can be applied to your New York sessions. This entire window of opportunity, okay, from 7 a.m. to 2 o'clock in the afternoon New York time, that could be your entire focal point for your trading. You don't care what's occurring so much before it. You don't care what's occurring after it. You're just trying to predict and forecast the price action movements between these two time windows. And you can further reduce it to noon, and that's no problem. Or you could make it 1 o'clock in the afternoon to get that little piece that usually goes beyond noon. Or you can trim it to 11 o'clock in the morning, and that ends your day. It's not something you should be wrestling too hard with, but from a perspective of understanding how these days that have big ranges can offer your opportunities, you need to be able to stick to a time frame that, okay, if I'm going to be hunting intraday trades or bread and butter setups, what are my work hours? What am I focusing on? Like, am I trying to get in here and turn these things into long-term position trades? Because without knowing how to do that style of trading, you could end up hurting yourself or losing potential profits by holding onto a trade too long. Or you can simply say, I'm going to treat the New York session like the Power 3 is for the daily range. I'm going to look for these types of signatures, which is when I'm in a bearish market and the market starts to rally up to a level I anticipate shorting at, you can visually represent the New York session or New York kill zone in the Power 3 perspective I teach when it comes to the full daily range. So in other words, what am I saying here? From this candle's opening at 7 a.m. up to the high, that's this here, the open and the high forming. Now, obviously the New York session is not the full daily range. We had a higher high formed in London. But if you're not going to be a London trader and you're not trying to capture the entire daily range and you're focusing on a real easy schedule to work with, New York session, you can treat the daily range the same way inside of the full daily range. That means everything is fractal. So the opening price here at 7 a.m., we anticipate a rally up. That's classic ICT Power 3. Market protraction due to swing, and they reverse it. And see a break in market structure there. And you start attacking this low, and then picking up any of your bread and butter exits. And as you transition to understand how you can hold for the daily range, you can leave a small portion on to ride out based on time and price. We have this window down here, which says what? London close. So if you're short and you're on side, always try to leave a small little portion on, because you might catch this runner once in a while. And over time, experience will teach you how much you should hold. Like I was saying before, partials and how much you take off, that's a personal thing you're going to bring to your own trading. There's no lessons, that I can give you that are hard and fast and or written in stone. So you're going to have to come up with that on your own, and that's what makes it your own. That's your own unique model, and it doesn't need to be a very specific thing where I always take 25% off or I always take 80% off and then do something else. Whatever you feel comfortable with. In the beginning, like I show you in my examples, you want to learn to take the biggest portion off, because it frees up a lot of the, fear that's gripping you. And that way, if it does turn on you and go back to your stop loss, it doesn't hurt as bad. It feels good because you took something out, and you quote unquote won something, and you reduced risk. So you're getting three things there working towards you. And that's a critical thing when you're developing or learning. And once you get better at this, you'll learn to hold a little bit more. You won't be such a hurry to take a large portion off. And that's what I mean by changing based on your experience. It'll shift from taking a big portion of the trade off on your first partial to taking, I'll take 20% off and leave the majority on to see if I can scale off later and try to ride out the majority of the move with some portion left on. So again, even though I've said this before, I'm still getting emailed, can you talk a little bit how much I should take off when I'm in the profitable trades? Because I'm in trades, I just don't know how much to take off. Well, that's something I admitted it openly. My exit strategy isn't as good as I want it to be because I can always see room for improvement. And that might be something that, is unrealistic for me to hold on to and force a opportunity for me to always try to improve it. So, my ego hurts when I don't get the better exit points. My entries are really, really strong, but because I have all these different views and interpretations of how I can work within price, I can get very easily distracted with one particular time frame and think to myself, well, this is enough for me to be done now because it's moved a lot based on this time frame. And invariably when I close and I have nothing left on the trade, I'll go through one more time in a higher time frame breakdown, and then I'll see, I should have held on because I see it's going to there, but I can't do anything about it. I'm outside the trade now. So as a mentor that's responsible, not only for what I try to say and teach to you, but also to try to inspire you to be flexible with yourself, you have to grow into your ideal exit strategy and how much you're going to take in partials. That's something that you're going to learn on a gradual trend, okay, of what you're seeing in your winning and losing, and the experience factor increases over time. And that's why I teach in the beginning, as you start to encounter setups that start yielding for you, pips, learn to take a big portion off. And you're going to find that it feels good to do that. It fixes that, I want the trade to be done. I want the trade to be done. And you won't feel rushed. And because you can't make these candles form any faster. Trust me. I tried to do that. It doesn't work. I go crazy when I try to paste these things and make them go quicker. I want them all to be big candles and go down to that target. But that's why it's important for you to understand that my concepts are focused primarily on teaching that the algorithm operates on time and price. Time is the first element. You have to submit to that. What does that mean? Well, if you're bearish on a particular market and you think it's going to go lower, try to aim for 10 o'clock to 1 o'clock in the afternoon New York time. That window of time is when usually the market will reach into that time window. Now, by what price level, that's entirely something altogether different, because you have to look at standard deviations, discount arrays, PD arrays, and see what lines up with the majority of those things and with potential of time of day. How long can the candle expand on the daily range? Well, ideally between 10 o'clock in the morning and noon, and as late as 1 o'clock in the afternoon. But it's very, very rare that 1 p.m. is ever utilized unless there's some kind of like FOMC or some kind of interest rate related news driver that's being released at 2 o'clock in the afternoon or 2:30 in the afternoon New York time. Primarily, the daily range is formed, unless it's a New York recession reversal, between 10 o'clock and noon. And many times you're going to find before 11 a.m. So, again, there's a lot of different ways you can create that for yourself as a work day. But whatever you settle on, try to stick with it. And let the ideal exit points that you see later on or after the fact, let them pass. Because you're going to find that you don't need those to do well. You don't need the entire daily range. You just need a nice, healthy pound of flesh a couple times a week. And you don't need to do a trade every single day. But you can see the Power 3 ideal scenario of delivering price as we expect on the daily range. is the same way here. Okay, so we're waiting for a particular price movement that would be above the opening price at 7 a.m. It rallies up, creates a Judas swing, optimal trade entry into a PD array that is a premium. We anticipate the market turning, and then delivery on the downside goes down to our projected low, and then we would anticipate, based on that price level being hit and time of day, this price level during that London close time period, that would be the cap on the daily range. It's not likely to see it expand much further than that on this one particular day. So when it trades down there and at that time of day, we would reasonably expect to see what form? This price movement here, the retracement off that low and closing at our session close, which is 2 o'clock in the afternoon. Okay, so hopefully this has been insightful to you, and you can see that this effect in price action is seen also on the intraday sessions. It can be seen on really nice trending days. Not so much on non-trending days or non-trending sessions, but coupled together with all the things you're learning in core content, it really gives you a comprehensive overview and expectation of what price should do even on a very small little window of time like a New York session kill zone. Until tomorrow, good luck in good trading and be safe.